You've heard the pitch. Skip your morning coffee, drop $10 into a trading account, and start a journey toward a lucrative full-time career. The standard Forex unit is $100,000, but brokers let you trade microlots, blocks of exactly 1,000 units. Since most lack $1,000, brokers bridge the gap with leverage. At a 100-to-1 ratio, a $10 deposit controls the entire 1,000-unit block. Technically, you are now a participant in a $7 trillion a day market, placing the same currency orders as international banks. Leverage provides technical access, but offers no help with the mathematics of surviving an open position. Let's look at the baseline. On a micro-lot trade, every single pip, the fourth decimal place in a currency pair, equals exactly 10 cents of real-world profit or loss. This chart tracks a 50-pip fluctuation against you. At 10 cents a pip, you've lost $5, half your entire account. And that assumes you start at zero. In reality, the broker's spread puts you in the red the moment the position opens. These combined losses quickly eat through your margin, the capital cushion required to keep a trade active. When that cushion hits zero, your broker issues a margin call and liquidates your position. The math of pip values and leverage leaves you zero room for error. On a $10 account, total liquidation is a mathematical certainty. Professional traders survive by never risking more than 1% of their total capital on any single trade. Applying that rule to $10 leaves you a maximum risk of 10 cents. That is exactly 1 pip. Standard market noise will shatter that boundary the second you click buy. To get any breathing room, you have to switch to absolute dollars. Risking a seemingly small $2 gives you a 20-pip stop loss, but it forces you to expose 20% of your account balance. Compare that to a professional strategy. At 20% risk, you are only 5 consecutive losses away from a total wipeout. Because standard risk management is physically impossible here, treating a $10 account as an investment is functionally equivalent to gambling. This raises a question. If the math is so clearly stacked against the trader, why do brokers offer these accounts at all? Think of a $10 deposit as tuition for a live psychological laboratory. Having real money on the line, even a small amount, triggers emotional responses that a risk-free demo account cannot replicate. This environment quickly exposes the YOLO gambler. Because the dollar value is low, they treat the account recklessly, abandoning their strategy to chase losses. It also reveals the fearful paralytic. These traders miss valid opportunities because they are terrified of a high percentage drawdown on their tiny balance. The micro account serves as a stress test, proving whether a trader can maintain discipline under these emotional extremes without breaking their rules. Once you execute your strategy consistently despite the pressure, the $10 experiment has served its purpose. You can then move back to a demo account with a larger balance to practice scaling up your position sizes without immediate financial risk. For live trading, a balance of $200 to $500 allows for the protection of the 1% rule. This gives you 50 pips of room for the market to move, rather than just 1. Approach that initial $10 as a tool for self-discovery and education, not a lottery ticket. Build a foundation on math and discipline, and start your sustainable trading journey with FXNX.